Okay, so let's look at these last two examples. First of all, we have an example wherein we need to make a decision as to whether or not we're going to discontinue a client, a product, a customer, a product line. And in this case, the scenario is a retail organization that has two stores, the Rhode Island store and the Connecticut store. The Rhode Island store, clearly you can see from the data I've provided, is losing money. They reported an operating loss of $25,000. And so we're contemplating closing it. And one additional piece of information is that if we do close it, we will be able to reduce corporate overhead costs by $44,000. So if we look at the results, if we do an analysis and see what it will look like if we close the Rhode Island store, we can see that, first of all, we will lose the revenues. Okay, that makes sense. We'll lose $860,000 in revenue. So the question becomes, will we save more in costs than we lose in revenue? So let's just go down the list of what we've got. We'll save cost of goods sold. That makes sense. If we're not selling the product, we won't, let me see if I can get this up here. Yeah. We won't have the cost of goods. I made an assumption here on the lease. I made an assumption that we can get out of the lease, or we can sublet it to somebody else and recoup our lease costs. That you'd have to look at. That may not be universal. If we had a 5-year locked into lease, then that might not be a savings. We'll save labor because we won't need those employees. Now, notice there is no savings in depreciation. As we talked about in the previous example, depreciation is a sunk cost. So it's merely an allocation of the original acquisition cost of equipment or leasehold improvements, whatever it may be, but there is no savings there. We're not going to get that money back just because we close the store. Utilities we will save. That makes sense. If we're not operating the store, we won't have electricity and heat, etc. Now, corporate overhead. You've got to be careful with corporate overhead. That is an allocated cost, which means that if they had not told us we could save $44,000 in corporate overhead, then there may not be any savings there. The $40,000 in corporate overhead that the Rhode Island store is currently absorbing would just be allocated to another store. So the only reason we're saving here is because the assumption said we could. Now, that being said, it looks like we'll be able to save $867,000, which is $7,000 more than lost revenue. So on numbers alone, it looks like this might be a viable alternative. But as always, there are other considerations. What impact will it have on our customers if we close the store? Will we lose their goodwill? Will they not go to the Connecticut store? What impact is that going to have on them? What impact will it have on our employees if we're having to lay off all the employees at one store? How will the morale be for our remaining employees? And is there another approach to take? Maybe closing the store is not what we should do. Maybe we should be looking at some of these costs to see if there's any way that we can save some of those or increase our revenues. What other strategies might we be able to put in place that are not quite as drastic as closing the store? The last example is one in which you have a constrained resource. You have limited resources, whether it's raw materials, whether it's direct labor hours, whether it's space to put your product. It can be any number of things. Then the question becomes, how do I maximize my resource so that I can maximize my profit? So in this example, I've got a company that produces 5 products. For each product, I've identified the number of units that we plan to produce, the selling price of each product, the direct materials we will incur, and the direct labor costs on a per unit basis. Then I tell you that we have a direct labor rate of $12 per hour, and we're allocating variable overcosts at a rate of $4 per direct labor hour. Now the question is, what do we cut back on if we only have 150,000 direct labor hours available? So our constrained resource is direct labor hours. So if we come down here to the analysis, you'll notice what I've done for each product is I've come down to a contribution margin per unit. Nothing new here. It is the sales price per unit minus the variable cost per unit. Now, you might think, well, let's go with product A. It has the biggest contribution margin per unit, so we can maximize our profit by making sure we manufacture as much as we can of product A. The issue, however, is that our constrained resource is direct labor hours, and if you look, each product uses a different amount of direct labor. Product A incurs $4.80 per unit. Product B only incurs $3 per unit. So it may be that while the contribution margin per unit is higher for A, the contribution margin per direct labor hour may not be. So when you have a constrained resource, your contribution margin is relevant based on the constrained resource, perhaps not on the per unit. So what I've done, first of all, I have identified or calculated how many direct labor hours are required for each unit. And I did that by taking the cost per direct labor cost for the product and divide it by the rate per hour. So if product A incurs $4.80 in direct labor costs, but we pay $12 per hour, then effectively we're spending 4/10 of an hour on each unit. Same thing for B, 1/4 of an hour, 7/10 for C, half an hour for D, 2/10 for E. Then I calculated the contribution margin per hour. So if we have a contribution margin per unit of $25.10, then we actually have a contribution margin per hour of 62.75 because we can produce more than just one unit per hour. And I did that for each of the products, and notice, even though A has the highest contribution margin per unit, B has the highest contribution margin per direct labor hour. So the next thing I did was I calculated the number of direct labor hours that would be required for the proposed level of production for each product. And what I found, there's the calculation, is we can spend 10,400 direct labor hours to produce that level of A, 10.5 for product B, 28 for product C, 23 for product D, and 90 for product E. All of this totals 161,900 hours. Clearly we have a problem because we only have 150,000 hours available. So the question becomes, where do we focus our time? Clearly, we're going to produce product A and product B. They have, without question, the highest contribution margin per direct labor hour. So we'll use maximum number of hours for A and B. Then the next highest contribution margin per hour is E at 46.5. So we'll use 90,000 hours for E. D is, we drop quite a bit then, but D is the next highest contribution margin per hour. So we'll manufacture all we can of that. C is where we're going to cut back, because C has the lowest contribution margin per direct labor hour. If we have to reduce production, we're going to reduce it in product C. And so you'll notice, to equal our 150,000 available hours, we will spend only 16,100 hours to produce product C.